Good morning, everybody. Going to do a quick interest rate update of where we're projecting everything and also an update on all the economic data that we've had this week, where bond yields are, what we're expecting for rate cuts in the future. So first things first, as you know, this month we did have the inflation data in Canada coming out for last month. It came out hotter than expected. But if you look down at the chart, it came out on around the 18th. The bond markets barely blinked at this information. You would think that hot inflation would mean more inflation in the future, which means our bond yields should have gone up a lot. Well, we had the same thing happen with the US economic data. They had their CPI or PPI data come in yesterday, and it came in hotter than expected. Even core inflation in both our countries went up. But if you see, we closed at a lower bond yield than higher, because you would think that, once again, with potential future inflation, you would expect bond yields to rise. They didn't. Now, why is that the case? Because the recession indicators are now very evident. Yesterday, not only did the PPI data come out for the US, but also consumer spending, which came in under what was expected. It's a major indicator that we're in a recession. Also, the markets dipped back down into recession territory if you look at the S&P 500. So now the concerns for the bond traders are, okay, there may be some inflation back here or there, but future growth, that's a major issue in our countries. They are now pricing in, of course, future rate cuts for the Bank of Canada and also future rate cuts for the Federal Reserve, in some cases more than they were originally expecting. So rates will continue to trend down this year. Now, if you're going to ask me about why there was that spike in the middle of the week, that's also very interesting, because we live in a globalized world where things in one country can affect the bond yields in another. So this week, of course, Germany announced that they're going to be investing a lot more money into their military, so essentially rearming, which means they're going to be taking on more government debt. Well, for a bond trader, it's like, okay, this country's going to be spending a lot more money, so their yields are going to go up. So we should probably sell our Canadian yields, hoard some cash to buy some German yields, because we're going to get more money there. That's why that spike happened, and you could kind of see it went up and then went back down. So that's why we had that spike earlier this week. No change in the fixed rates. Fixed rates didn't go up. Our fixed rates have been pretty consistent for the past few weeks. Still getting it depending on the package. If you're a high ratio or insurable, you're looking and still with a 3 in front of your mortgage there. So not bad. Once again, more rate cuts to come from the Bank of Canada and the Fed.